Okay, everyone, it's 11 o'clock. Welcome. It's a beautiful day outside, so I hope after this, everyone can get outside and enjoy lunch or a walk. So my name is Maria Gambacorta. I'll be hosting the webinar today, and Lumsden and McCormick is very happy to partner with Mathias to bring us this webinar today on the employee retention credit. Before we get to introductions, I'm just going to run through a few housekeeping items. We are offering 1 hour of CPE credit for this webinar for all the CPAs. In order to qualify for the CPE, you need to answer 3 of the 4 polling questions. So if you could please answer all of them. And at the end of the webinar, there's a short survey. It's only 11 questions. Excuse me. We'd ask that everyone please complete that survey as well. For those wanting CPE credit, we will email you a CPE certificate by the end of April. So you can expect that in an email from us. As you can see, the chat and the Q&A are enabled. If you have any comments, you can just place those in the chat. And any actual questions, we'll leave about 20 minutes at the end of the 60-minute presentation to allow to answer your questions. Note that some of the questions may be too technical for us to answer in this format, but if you leave us a note, we'll happy to follow up with a phone call and answer your very specific question. So before oh no, actually, never mind, I'm going to take that back. I'm going to turn the program over to Corey Van Duzen. Corey is a CPA and partner in our tax department, and he has over 15 years experience, and he focuses on tax matters for businesses with a focus on business development incentives. So take it away, Corey.
Thank you, Maria. And you made me sound young. That was awesome. I've actually been here about 21 years now. It's kind of crazy. I'm getting old. But welcome to all the clients, prospects, friends of the firm, friends of Lumsden McCormick, friends of Lippis Mathias. I hope you get some good information out of the presentation today. Unfortunately, I won't be entertaining you long. The show is going to be stolen by Megan and Matt. They're going to talk about the employee retention credit, and I think we did a seminar on this maybe in January. Meg, was it January?
Yep, January.
Yeah, in January. Might have jumped the gun a little bit, but now this is getting a lot of play. And as Matt and Megan are going to talk about, it can really provide some nice cash flow to businesses in the form of reductions of payments on some payroll tax returns and or a refund. And Matt's going to cover all the crazy questions that are about shutdowns and not shutdowns, and answer any question that you want. Now, there might be some stuff that we're going to answer later on, like Maria said, or might be so specific it's better to talk offline. But we will try and answer as many questions as we can. Megan Morris is a tax manager in our commercial group at Lumsden McCormick. Meg's been with us for quite a while now, and she took the lead on PPP, which is just got extended again, I think, until the next 2 months or something like that. They'll probably come out with a 4th round and a 5th round and a 6th round, and it'll never die and never go away. But originally, this employee retention credit you couldn't take and the PPP, you had to choose one. But now further guidance came out, and this has been extended through 2021. So Meg's going to go through that. And then we also have Matt. I learned something about Matt Clouden today. He came back to Buffalo from, what was it, 10 years in Boston, Matt?
10 years in Boston, that's correct.
Yeah, that's awesome. So I got my Buffalo is numero uno shirt back there. Normally I have my will do taxes for beer, but I thought I'd switch it up on everybody today. So with that, I'm going to turn it over to the experts, and I'm just going to be here to look pretty on your camera and try not to talk, which is really, really hard for me. So with that, Meg, Matt, you want to take it away?
Yep. Hello, everybody. Thanks for joining us on this beautiful day here in Buffalo. So kind of what we're going to go over today is we're going to talk a little bit about why now, why in 2021 are we hearing a lot more about the employee retention credit than we originally did in 2020. There's two kind of components of the employee retention credit. So there's separate rules for 2020 compared to 2021. So we're going to kind of break it apart and look at it almost like it's two different credits with sort of some similar rules that cross between them, but the computation is different. So it's a little bit easier to think about them on a separate basis. Then we're kind of going to get into some special issues sort of surrounding the employee retention credit and how we claim it. And then finally, we'll go through those questions and try to answer all the questions that you have. So feel free as we go along. We're not going to do questions in the middle of the presentation, but just drop them in the Q&A over the chat just to kind of keep them all in the same place for us. So we're going to kick it off with a polling question. So this first polling question is, did you attend our January webinar about the employee retention credit?
I was trying to vote and I see there's an error that says I can't.
Panelists are excluded from voting, Corey. We'll give it another couple seconds. I still see a few more trickling in here. Okay, I'm going to end the poll and I will share the results.
All right, so it looks like we've got a nice mix today of people that watched our webinar last time. It is going to be for you repeat attendees, welcome back. A lot of it is kind of similar content to last time, but sometimes it's never good to, or it's always a good idea to hear things again. And there is a little bit of tweaks that have changed with new guidance. Okay, so why now for the employee retention credit, and why didn't you maybe hear that much about it in 2020? So in 2020, under the CARES Act, PPP borrowers were not eligible to claim PPP and ERC originally. However, ERC didn't really get a lot of participation from people because it was sort of complicated. PPP was a lot more beneficial program for most people whenever we did analysis. So we had a lot more of our clients go after PPP, which excluded them from ERC. However, right around Christmas, we got a gift that PPP borrowers were eligible to also claim ERC. So this opened up the doors to a lot of possibilities, which is why you're seeing us market it a little bit more. The IRS is supposed to get funding to help advertise this a little bit more to help taxpayers get some extra cash flow. And in December, this was not only PPP borrowers made eligible, but it also expanded the credit, which originally expired December 31st, 2020, to the first and second quarter of 2021. Then again, we keep getting more and more stimulus bills. So a couple weeks ago, we got the American Rescue Plan Act, which probably the stimulus payments are the biggest things that people here have heard about from that act. But also it did expand the employee retention credit to all of 2021. So if your business qualifies for 2021, this can be a really great source of cash flow to kind of help you recover from the pandemic as hopefully we start to turn things around in 2021 and businesses start to improve. So if you haven't heard of this before, it's a payroll tax credit. So it's going to be recorded on your 941 with your payroll tax filings. So let's look at the employee retention credit for 2020. So in order to be eligible in 2020, you needed to have a full or partial shutdown and during any calendar quarter in 2020, and your gross receipts were less than 50% of the gross receipts in the same quarter as 2019. So basically under these two categories, so your operation of your trade or business was partially suspended or fully suspended if there was a governmental order that imposed restrictions on your ability to operate by limiting commerce, travel, or group meetings due to COVID-19. So you could be partially suspended if the government order only restricted part of your operations and not all of them, but we're going to dig into kind of what this means a little bit in the future. And initially there was just some IRS frequently asked questions online, but a couple weeks ago they released some lengthy guidance that kind of delves into this a little bit more about how you could meet this. So for our clients, we're kind of seeing, a lot of you were more impacted in 2020 by government restrictions than you are in 2021, but they still are around as far as how people need to maintain social distancing and maybe different work situations or schedules for like essential versus non-essential businesses. So it is still a concern, but will largely be more applicable in 2020. And then most of our clients that are qualifying also will qualify under this gross receipts test. So, if in 2020 it was a bad year, we're seeing a lot of people, especially, in the second quarter of 2020 when everything shut down. If your gross receipts were less than 50% of what they were in the same quarter of 2019, you can qualify for this credit. You would then continue to qualify in 2020 until the first calendar quarter where your gross receipts are more than 80% of what they were relative to that same calendar quarter in 2019. I think this concept is a little bit best explained with an example that I'll be getting into in a little bit. And then in 2020, federal and state governments or any governmental agencies were not eligible for the ERC. If you're wondering what's included in gross receipts, for a for-profit organization, gross receipts include sales of products or services, net of any returns and allowances, any investment income, so interest and dividends, any real other form of income like rents, royalties, fees, commissions, receipts from the sale of capital assets, which would be reduced by your basis in the asset for for-profit organizations. So it really is kind of encompassing everything in terms of your gross receipts when you look at for this test. It does not include, so any like sales taxes, those would not be included, any loan repayments, any proceeds that are between you and a foreign affiliate or a domestic affiliate, but you would have to look at this test on a consolidated group basis, which is what we're going to get into for affiliated rules in a little bit. For any of our tax exempt organizations on the call, gross receipts include any amounts received. So that could include your contributions, your gifts, your grants, any member dues or assessments. If you have any UBIT activities, so those sales and receipts from those types of activities, investment income again, and same with the sales and assets as well. Those are also included. So it really is kind of encompassing everything. So kind of to show how this test works in 2020 for the gross receipts reduction is over here on the left. If we had 2020 quarterly gross receipts, so in Q1 we had 100,000, but in that same quarter, Q1 in 2019, we had 210,000. So we had a 48% drop, or our receipts are 48% of what they were in the same quarter of 2019. So they were a 52% drop. Then in quarter two, we were back up to 83% of what we were in 2019 versus quarter three, we were 92% of what we had in 2019. So in this case, where we didn't meet where we had an over 50% drop in Q1, we would be eligible for the ERC. And then we continue to be eligible until we're back over 80%. So that would be through the end of Q2, we would still be eligible. So in this case, using these receipts as an example for 2020, we would be eligible in quarter one and quarter two. And I guess for quarter one wages for 2020, it's just wages starting after March 13th that qualify for the employee retention credit. All right, so we determine that we qualify. How do we determine the maximum amount of our credit that we're allowed? So basically in 2020, the credit is a 50% credit of qualified wages, which includes health plan expenses per employee up to $10,000 of wages for the entire year. And kind of to repeat what I said last slide, the wages that would count for this would be any wages paid from March 13th to December 31st. And the maximum credit per employee is $5,000. So kind of keep this in mind in 2020, it's not as beneficial to people because, you know, kind of once you hit that $10,000 of wages per person, you're done and that's it. So qualified wages, kind of delving into that a little bit more. So it would be wages including healthcare costs. In 2020, you can include kind of any salary increases or bonuses. So basically the IRS didn't want you issuing kind of a bonus of $10,000 to somebody and then claiming a 50% credit on that. As you're going to hear me probably say too many times this webinar, like a broken record, You cannot combine or claim wages for multiple credit programs. So if you have this, if you're using multiple credit programs, that's fine, but you can't claim the same wage dollar. So if you have PPP in 2020, when you're doing forgiveness, you have to make sure you separate that for ERC. Same with work opportunity tax credit, FFCRA wages, paid family leave. So just make sure if you're claiming all these programs, it can be a really great benefit, but just, I would recommend keeping a spreadsheet or something, documentation that definitely supports that you're not double dipping anywhere. You'll probably hear me repeat that several times, so I apologize if I repeat that too many. And then also self-employed earnings and wages are not eligible in 2020. Okay, kind of for 2021, big limiting factor that we're seeing for our clients that maybe struggle a little bit and they meet that gross receipts drop is there's kind of this overall restriction that looks at your number of employees. So if in 2020 you had more than 100 full-time employees, and this is based on a 2019 test, you can only claim the employer retention credit on wages paid to employees who are not providing services. So basically wages or health costs that you paid to somebody that was staying home or they were furloughed and you were still covering their health and costs. If you have over 100 employees, that's all that you can use the ERC for in 2020. So we're seeing a lot of clients, that have over 100 employees, this program really doesn't matter for them in 2020 because not many people are going to pay their employees to not do anything. So for this test, it's based on a 30-hour work week is a full-time equivalent. This is different from your PPP test, which is a 40-hour work week. And if you do have people that qualify for this program, you can't, pay them any more in additional wages versus what they would have been paid for the 30 days prior to the period where they weren't performing services. So basically, you couldn't furlough somebody and pay them a bonus and then take their credit on it to try to qualify under this. So how you compute these average full-time employees is you take the sum of full-time employees in each calendar month in 2019, and then you divide that total by 12 to get your average. So if you think that this is an issue for you or you're worried about it, just feel free to reach out to us. I know it can be a little bit confusing, and this does get a lot more favorable in 2021, as I will get into in a bit. So before I get into 2021, we're going to launch our second polling question, which is, have you heard from your payroll provider about the employee retention credit?
Just a reminder to all the CPAs on the call, you need to answer all of the polling questions in order to qualify for your CPE credit. So I'll give it a few extra seconds and then we'll end the poll in about 2 or 3 seconds, please. Thank you.
Like Maria put in the chat too, if you could load your questions into the Q&A and not the chat. So I only have to pay attention to one. That would be awesome. I would appreciate that. Thanks.
Okay. And end the poll, everyone. Thank you.
All right, so this is another one where we're 50-50 of whether we've heard from our payroll provider about the employee retention credit. So people should be marketing this more. We're starting to see more news and more guidance kind of come out about this, but it really is a payroll tax credit. So it's been interesting to see that kind of these big payroll companies aren't really pushing this as much. You're doing a lot to educate their clients about it, which I think is sad because it is a great cash flow opportunity, but that's why you have us here giving you this webinar and teaching you more about it. So, all right, moving on to the 2021 employee retention credit. So our eligibility is slightly different than what it is in 2020. So we still qualify, if our business had to be partially or totally shut down due to COVID-19 in any calendar quarter in 2021. However, the gross receipts test changes slightly, so it's a lot more favorable in 2021. So basically, if your gross receipts are less than 80% of the gross receipts in the same quarter in 2019. So this is also just based on calendar quarter. So if you have more than a 20% drop, you're eligible, and it's still based on 2019. So for our clients that had, really great years in 2019, we are seeing that they're, eligible for 2021 and it will be a nice benefit. And kind of just as a reminder, this originally was only available for Q1 and Q2, but it has been expanded for all of 2021 as a benefit to you. There is a safe harbor for 2021 as well. So how this works is you can elect to use your previous quarter. So if you're worried about 2021 and you don't have your financials before you usually file your 941, you can look at the previous quarter before that quarter and determine whether you are eligible or not. So just as kind of two examples here, for the first quarter of 2021, you would take a look at either your fourth quarter of 2020 compared to the fourth quarter of 2019, or your first quarter of 2021 compared to your first quarter of 2019 to determine whether you're eligible for Q1 of 2021. And then kind of Q2, similar concept. You would look at Q1 2021 to Q1 2019, or Q2 2021 to Q2 2019. So in kind of all of these slides for gross receipts, I'm usually assuming that somebody had activity for 2019 and you had a full year of activity. If you didn't, there is guidance that shows what quarters you would need to use to compare to. So just reach out to us and we'll let you know and help you out with your situation to determine whether you're eligible or not. And kind of a lot of it would be if you didn't exist in 2019, kind of for a basis for that, you would use either 2020 comparison periods or look at maybe kind of duplicating that 2019 period. So kind of continuing with some new changes for 2021 as well. So bonuses and salary increases can now be included in the qualified wages. So this will allow, any additional amounts in 2021. Also, the program was expanded to allow for governmental entities. So mostly like public colleges and universities, kind of hospitals, those types of entities are who are also eligible in 2021. The IRS has released guidance about 2020, like 80 pages worth, but they haven't yet to do so for 2021 yet. So we're kind of waiting for that guidance to come out, and hopefully it will come out soon to kind of clarify any little additional open areas for 2021. So how does the credit change in 2021? It's a lot more beneficial. So in 2020, we had a 50% credit. However, in 2021, we have a 70% credit. So obviously right off the bat there, that's extra benefit. Also, 2020 was only $10,000 of wages for the year, where 2021 is $10,000 of wages per employee per quarter. So this is really, really powerful in 2021 if you qualify for this credit, because obviously your wages just were all available, and this is the same rules for July through December as well. So the maximum credit per employee per quarter is $7,000. So this could be really powerful, if you are still having a really down year this year compared to 2019 and business is still bad, you could get possibly up to $28,000 per employee from this credit. So obviously it could be a big, big benefit. But again, you have to keep in mind that if you had PPP2, so you get your round 2, hopefully you got your funding, but you cannot double dip any wages for ERC that you're going to use for forgiveness. So I would just kind of exercise caution when you're claiming your ERC for 2021 and make sure that you don't claim any wages that you will then need for your PPP forgiveness application, to make sure you don't cut yourself short on PPP. That 100 employee restriction in 2020 increased to 500 full-time employees for 2019. So basically you would look at full-time employees that are working a 30-hour week for 2019. And basically if you have more than 500, then you're subject to this test where you could only take the employee retention credit in 2021 on employees who are not providing any services. So for a lot of our clients, they're under that 500 employee threshold. So this is including kind of between the changes in the receipts requirements and also this 500 employee, we're seeing a lot more clients be eligible for this credit, which works out well because it's a larger credit as well. There is some new kind of stipulations in the American Rescue Plan Act that was just passed a couple weeks ago regarding startup businesses that became into formation after February 15th, 2020. And also businesses that have been really hardly hit if they had a 90% drop in their gross receipts, which I hope does not apply to any of our clients today. But there is possibly new benefits to kind of take the credit on different things, but we're kind of waiting for more guidance since that was a fairly recently passed law. So if you think that any of those situations could apply, just let us know. And when that guidance comes out, we will help you with it. So one thing that I think is really helpful is kind of looking at this from a credit computation for an example here. So we have kind of 4 employees for our example. And here's how we have our qualified wages listed all there. So if we kind of look at Corey, because he is an owner, we're going to claim $20,833 of his wages for PPP. So for right now, this is kind of assuming that Corey is a partner in a partnership, so he does not get any kind of distributions. He just has self-employment earnings, so then he wouldn't be able to take any ERC wages. We're kind of waiting on clarifying guidance regarding S Corp owners and those wages. Right now, our understanding is that they would be able to take those wages into account for ERC, but there's competing knowledge or conflicting knowledge in articles online that you read where some people say owner employees would be eligible, some say they won't. So we're hoping the IRS clarifies this as a kind of a widespread area of confusion. For me, if I got $5,000 of wages in a quarter, but I got sick, so I had FFCRA wages for $1,000, we can't claim those wages for ERC. But then we decide that we want to maximize my ERC wages for $4,000 to kind of take the biggest credit there. We wouldn't be eligible to take any of my wages for PPP. So say we didn't need to use wages for PPP because we had enough elsewhere, we can maximize for ERC. And then Jenna and Matt are both kind of similar situations here where they had more than $10,000 of qualified wages. So we're going to take $10,000 for ERC. And then we're going to leave those remaining eligible wages for PPP forgiveness, which gives us a full $7,000 credit each. So in this case, this kind of can show when you stack PPP on top of FFCRA and ERC, that you would possibly get a benefit of $50,683 on only $67,000 worth of wages. So it can truly show like how powerful this can be as long as you make sure that you're allocating your buckets and not double counting anything. So kind of just in summary here of what those differences were. So as kind of a reminder for our credit percent, it is 50% of qualified wages for 2020 compared to 70% of qualified wages for 2021. For maximum wages allowed, in 2020, we get $10,000 per employee per year, where in 2021, we have $10,000 per employee per quarter. That results in only allowing a $5,000 credit for 2020 per employee. However, in 2021, it'd be $7,000 per employee per quarter. For gross receipts, we need that 50% decline, where it's only a 20% decline in 2021. And then our employee threshold for where we're going to have limited eligibility. So we have issues when we have 100 full-time employees in 2019, but that expands to 500 full-time employees in 2021. So with that, we're going to move into our next polling question here.
Most of you have answered this, but we'll give it a few more seconds. Like I said, we'll do our best to email the CP certificates by the end of April. If not, it may linger into May, but as with past events, we are very timely in getting these out to you, so we'll continue to do so. So, okay, I'm going to end this poll. You can move on, Megan. Thank you.
All right, so I am sure you are probably all sick of hearing me talk for right now, so I'm going to turn it over to Matt, and he is going to kind of get into some of the special issues kind of regarding ERC and surrounding that.
Hi, everyone. Happy to be here. Happy to help with you getting your ERC. So now that you know what the credit can be, the question becomes, am I eligible to get that credit? So there's a few hurdles that have been put in your way, as with anything when it comes to these government programs. So the first hurdle, and some of you that may have experienced PPP and the word affiliation, I assure you this is not the same thing. It's much better than it was for the PPP. I assure you, but there is what they call aggregation. So it's a similar test to the PPP, but it does not disallow you from getting the ERC. So that's good. But what is it? What are they looking at here? So in this case, they go to their tried and true Internal Revenue Code, and they have two sections which they use to essentially say if you are a group of businesses, treat it as one. This has some impacts, which I'll get into in a little bit, but essentially these two sections are for tax credits and retirement benefits. So if you meet the test, any individual company that you have that may be technically separate are going to be treated as one entity for computing your ERC. There's a lot of minute details when it comes to this, so I'm not going to bore you with those at the moment. But the big thing you need to know is if you personally or a business that you are a part of owns 50% or more of another company, talk to us. That likely is going to create an aggregation scenario for you. So if that is the case, come talk to us. We're happy to help. There are a few exceptions, but basically if you hit that 50% mark, that's probably what you're probably going to have to worry about this. So, some typical, scenarios where this is going to occur is going to be a parent subsidiary relationship. Sister companies, one company owns a certain number of another company, they share management, etc. Or, you just have a whole amalgamation of companies here, there, everywhere. There's a number of different scenarios where this will occur. So you need to, so again, if you're hitting that 50% mark in any of those situations, please come talk to us. And these apply to the full gamut. So if you have a trust, a partnership, an S Corp, a C Corp, an estate, this is all going to apply to any of those situations. So now that we have talked about what aggregation is, what is the impact on you when it comes to the ERC? So as we'll get into what a full or partial shutdown is in a little bit, essentially if your companies are deemed to be aggregated, it can be extremely beneficial actually, because if one of your aggregated companies experienced a partial shutdown, all of them did. It's a zero-sum game here. So if in that sense, it can be very beneficial, because if you had, say, a restaurant and a restaurant and some essential business that did not close, that was not affected by this, the restaurant being closed and having a partial shutdown will allow you for the aggregated group of companies to apply for the ERC. So that is a potential benefit. The potential downside here is you also put them all together into one pot when you're calculating your gross receipts. So if you had a company that was able to function relatively well, if not better, during the shutdown or any period of 2020, 2021, and you also own a restaurant which absolutely got killed, you're going to have to go in and do the math and see if it works. You may qualify on, what I'm going to drone on about is full or partial shutdown or gross receipts. You can apply on either, you can qualify on either one, but in this case, you might lose yourself, you might be able to knock yourself out of qualifying for the ERC because your one business did extremely well and the other one, while it didn't do very well and it would meet the gross receipts test by itself, if you aggregate them together, you don't meet the requirement. So that could be a potential downfall. And then the other one that can be a potential downfall is determining the number of employees. As Megan went through earlier, when you hit the threshold in 2000, the 100 employees, in 2021, the 500 employees. So again, similar to the gross receipts, you take all your companies, you average out all of your employees, and you figure out whether or not you're tripping that threshold or not. Again, this is to stress as much as I can, this is not PPP. This is not if you hit that 500 employee, 100 or 500 employee limit threshold, you are disqualified from getting the ERC. That is not the case. You just have to go into that separate different calculation for being a large business versus a small business. So again, not PPP, does not disqualify you. If you trip that 100 or 500, you just unfortunately have to go into that little bit more punitive calculation for calculating your ERC credit. So now that we've talked about aggregation and what that affects, the big question here is, what is a partial shutdown? Full shutdown, I think it's pretty, I think you knew if you have a full shutdown. If you were shut down and you were fully shut down, couldn't do anything, I'm sure that I don't need to drone on as to what that is to you. The gray area here is a partial shutdown. Now, not that anybody's going to voluntarily partially shut down, but if you did, unfortunately, you don't qualify for the credit on the basis of a partial shutdown. You may qualify based off of gross receipts, but if you voluntarily shut your doors, then that's not going to help you here. You have to have had to shut down because of a governmental order. And the government order must have affected your commerce, your travel, or group meetings. And as we'll get into a little bit, group meetings do not mean I had to have Zoom meetings. It means you weren't able to have group meetings at all. So let's get that out of the way here, and we'll touch more on that in a few minutes. But so a partial shutdown essentially is a government order came down and you either needed to fully shut down your business or aspects of your business needed to be closed. So we'll get into some examples later, but essentially more than a nominal amount of your business activities need to have been shut down. That was pretty amorphous until a couple of weeks ago, where the IRS finally came out and told us that nominal means 10%. So if 10% of your business activity was shut down because of a governmental order, you can claim a partial shutdown, more than likely. And again, remember, you have the aggregated group. If that does affect you, this is actually might be beneficial to you, because if one of your members of your aggregated group shut down, all of them did. So it's as I said, it's a zero-sum game here. So that could potentially be beneficial. And remember, the qualified wages are the only ones that may be claimed while you are shut down. So the biggest question here is going to be telework, working remotely. Does that constitute a partial shutdown? And the answer is, it depends. It completely depends on what your business is, what you do, how you do it. So I have two examples for you here. So I'm going to pick on the Lumsden people here. So a CPA firm in March was told that everybody's got to go home. Nobody can work in the office, but CPA firms, most of them, at least ones that I've dealt with, have the ability to work remotely. So despite the fact that no one was allowed to walk into the office, no one was able to meet together or whatever face-to-face, for all intents and purposes, as far as the IRS is concerned, their business operations did not change. They were able to do their day-to-day for the most part. They were able to, continue their operations reasonably similarly as they would, prior to the shutdown. My second example is a hair salon. So a hair salon, similar to the CPA firm, in March was told shut it down, you can't do anything. Now, I personally have some hair salon connections, so I understand that they did a nice pivot and they're like, okay, we'll sell hair products online, we'll sell gift cards, we'll, maybe we'll do some videos as to, like tutorials to cut your hair at home. They were able to have an online presence and work from home to, a certain extent, but, they weren't able to cut people's hair. So in this situation, the CPA firm will not be seen to have had a partial shutdown. They were able to continue their operations to some level of that they were prior to the shutdown. There, obviously things became a little more distant, a little more remote, but for all intents and purposes, they were able to do what they needed to do. My second example, the hair salon, despite the fact that they were able to do some stuff online and they had some online commerce going and they made, they pivoted for themselves. They're going to have seen to be shut down because their main business is cutting people's hair. It's not selling product. So the shutdown did not allow them to cut people's hair. So that means that in that instance, a hair salon, 100% able to claim at least a partial shutdown, if not a full shutdown, and will be eligible for the credit. So going into some more examples, because the telework example is probably the one first and foremost on most of our minds, because a lot of us did have to get used to working from home. But there are other ones. So the first bubble on the under qualifying there, you had essential businesses that were still able to stay open, still able to operate as they would because they met the essential business list. They were able to stay open. But sometimes those businesses were impacted. If you had essential construction going on, but it was really hard, so they weren't able to get supplies because of other governmental orders, et cetera, et cetera. They couldn't get employees because, unfortunately somebody got COVID and they had to shut down. And all of those sorts of orders, all of those sorts of situations would allow for that essential business, despite the fact that they remained open, to claim the ERC because of the orders impacted their business. And if you can't get supplies and you're in construction, you can't do the construction, it's going to be over a nominal amount, more than likely. So if that situation, you're good. On the flip side, if you have an essential business and you're able to stay open, but your business decline, you were not as profitable, that does not count as a partial shutdown. Again, to reiterate, you may qualify based off of gross receipts in that instance, but in this instance, you're not going to be able to claim a partial shutdown just because your business declined. So I'm an example person, so I'm going to go through two major, industries that, probably first and foremost on our minds when it came to our day-to-day and how the shutdowns affected them and what would allow them to claim a partial shutdown. So one of the first things ripped from us was the ability to go sit down and have dinner with friends, family, whatever. So restaurants, as of March 15th, whatever that fateful day was, completely shut down. No more indoor dining, carry out only. And obviously that even took a couple of weeks for that to be allowed. So in that instance, I think it's pretty clear there's at least a partial, if not a full shutdown. For that period of time, the restaurants are able to claim the ERC. Then things got a little better, numbers came down, weather started getting better. So it's like, okay, you can do outdoor dining, but still no indoor. You can't, but we can do outdoor dining. Because they still weren't able to do indoor, which is a big facet of their business. I mean, a restaurant is 4 walls, brick and mortar. Despite the fact that they were able to do outdoor dining, they were still partially shut down because of the indoor restrictions. So second step, still able to claim the ERC. Third step, which is where most of the country, but especially New York State is right now, where indoor dining is allowed, but there are, very strict capacity requirements. There are very strict spacing requirements. My friends in the restaurant industry are, able to operate, but they're probably, even though they can operate at 25%, they're probably only operating at 15 because of with the spacing requirements. So there is still an order that is truly affecting their day-to-day. In today's world for a restaurant, you are still able to claim a partial shutdown. So because the main tenant of your business is still being affected. So if you own a restaurant, you are certainly qualified for the ERC from March 13th through today. And, maybe the restrictions ease up in the next month or so, but at least in the short term, you're going to be able to qualify in Q1 and Q2 for 2021 as well. Another example is retail. This one's a little different. So initially, everybody got shut down. We weren't able to go in the store to buy anything except for the grocery store, etc. But let's say, the boutique shop on the corner, they weren't allowed any, and no one was allowed in. They could do curbside, but no one was allowed in. So that 100% constitutes a partial shutdown. No one was allowed in the store. They could do some business online or curbside, but no one was allowed in the store. That is a partial shutdown. Now you have in-store shopping allowed, but they're, spacing, capacity, etc. But the IRS has come out and said that this is not a partial shutdown because you can still do business in your normal way. It just may be people may need to wait outside, or you may not have as much business. And this goes into that, first non-qualifying example I said with an essential business that has, they lost some business. That's not the IRS is not seeing that as a partial shutdown. Again, you may qualify based off of gross receipts, but you're not going to qualify based off of a partial shutdown. And so I guess the two biggest takeaways here for what is and is not a partial shutdown is, again, a decline in revenue is not a partial shutdown. It maybe get you to the level you need to get for the gross receipts test, but it's not going to get you there on the partial shutdown side. And then the second big one is just because you went remote does not mean that you had a partial shutdown. You need to take, you can come and talk to one of us, as to what we think, but you need to understand what your business is, what you're doing, how you were able to do it during the time that you're teleworking, or continue to do it if you still are working remotely, and come to a determination based off of that. And then, so another big one is wages paid to related individuals. You cannot, if I own my business and I'm paying my son, I can't do that. Obviously there's a lot of room for, goosing things up there, and the IRS is very concerned about that. And I don't know, Meg, if you want to step in and get a little more detail on that.
Yeah, so basically kind of here where we have an issue is if we have more than a 50% owner, these kind of related wages and things become a lot more into consideration. So this kind of hurts, your mom and pop, your small businesses where we really hire a lot of employees and our family members, and they are coming in and they are working, but it's kind of designed so that we're not just saying like, hey, I'm going to pay, my kid, he's 17, he's not coming into work and doing anything, but I'm going to give him $10,000 and I'm going to claim a $7,000 credit. That's kind of where the IRS is, trying to stop this here. So unfortunately, this list can be kind of restrictive for our clients that, they really truly have people that are coming in, they're helping in, they're doing the job, they're not getting paid to just kind of be a family member. But it is something to consider when you're looking at your credit, and just make sure that you reduce those wages out, make it really clear and obvious that you will be. Because I think one thing that's kind of important to mention here is we don't really know, what the IRS is going to do, how hard they're going to go after these claims or anything like that. So if you've got like a partial shutdown that we're claiming under, you have anything questionable related to related individuals or anything like that, make sure you document the position that you're taking, why you're taking it, and make it very clear for what you did. So that way, in case, the IRS ever comes knocking, you can kind of say, well, at the time, this is the guidance that I had, and this is how I was trying to operate. Kind of again, I guess, quickly, just to kind of put it out there to touch on the interaction of PPP and ERC. So you can receive both We can't double dip the wages, gone over that probably too many times. However, one thing in the IRS guidance that was interesting was it wasn't super friendly for taxpayers that had a PPP round 1 loan and already filed for forgiveness, and maybe for the sake of easing documentation requirements, they only claimed payroll when really they also had rent, mortgage interest, other qualifying PPP forgivable expenses. The IRS was not favorable in that way. If those expenses were not on that PPP application, we cannot use them and try to allocate more wages and say like, oh, we claimed, our 100% of our wages for PPP, but really we have, 25% of these other expenses. We could really lower it down. No, unfortunately, you cannot do that. So you could use wages, if you had $500,000 of wages on your PPP forgiveness application, but really your loan was only $300,000, those $200,000 extra there, those are still kind of like fair game. And if for some reason the SBA were to deny any part of your forgiveness or your expenses that you were claimed, those we can look at and see if we can do anything with ERC. But unfortunately, the guidance was not super favorable if you, already filed for forgiveness and just didn't list expenses because you didn't think that you needed to. So maybe the IRS will change that position. I know there was kind of some disgruntled lawmakers when that guidance came out. So subject to change as this all is, because guidance is constantly evolving. But right now, that was not super favorable to taxpayers. And kind of to touch on the tax treatment here. So there will be an add back to taxable income for the amount of the employee retention credit you receive. So even though this is on your payroll tax return, technically in the geography of the return, it'll really be like a reduction of your wage expense for the amount of the employee retention credit. So it won't be, the $10,000 of wages, it'll be the $7,000 of credit. But however, even if you have to do that and you have to pay the tax on that, it's still much more beneficial than not getting that credit at all. Also, for any of our manufacturers or tech companies out there that are claiming the R&D credit, once we use wages for the ERC, they're no longer eligible for the R&D credit. So we'll have to reduce those employees' wages. One way to kind of get around this, if you will, or mitigate the impact of it, is if we maximize health plan expenses for those employees that have R&D activity, or really just kind of look at, if you have R&D, maybe maximize health expenses first for all employees before you look at wages. That'll help because health plan expenses don't count for R&D, to kind of help you maximize both. Don't worry about this too much. The R&D credit is very powerful and it's a great tool for those that qualify, but the ERC is going to be at 70%, is a much higher dollar for dollar credit than you will ever get with R&D. With that brings us to our final polling question before we start kind of getting into your questions. So this question is just kind of about if you think you will qualify, or maybe you already claimed the credit for 2020 or 2021.
We do have a lot of questions. There's over 20 questions and it's about 5 to 12. So we will do our best to answer all the questions and may extend the webinar for 5 minutes or so, maybe even 10 minutes. So hang tight with us as we get through those questions for you. And the vast majority of you have answered this poll. So I am going to end the poll and we will share the results.
All right, so it kind of looks like a mixed bag there for who will be taking the employee retention credit. And some of it too, as you might not know, things might look great now, but maybe by the end of the year, it's interesting to kind of see how the pandemic is hitting all of our clients. So with that, oh, whoops, I forgot that I had some slides in here about claiming the credit. But basically this is just, since we're short on time here, it'll go on your 941. You can kind of work with your payroll company or with us to help you claim it. If you want, there's 2 options for 2021. You can look at either getting an advance payment of the credit, or you can reduce those federal employment deposits as well. So that can be kind of ways to help get the credit and get your money. Just make sure if you're working with your payroll provider, they oftentimes might not know what you're doing from a PPP side or anything like that. So just make sure somebody has the whole picture. So that way we're making sure we're not double counting anything in ways that we're not supposed to. And then the IRS did clarify this, that if you wanted to go back for 2020, you'd have to do it on an amended return for your 941. And when that's due is you have pretty much 3 years from when you filed your 941 to submit an amendment. And the notice recommends doing that 90 days before that statute of limitations expires. So basically you have a little less than 3 years to do it. So it's not something that we need to rush right away, but definitely timely is better, and trying to get it in sooner rather than later would be better, but you have your time to figure out your PPP and make sure you're all set for that. All right, so with that, so we can get into people's questions, because I know there's a lot of them. If you have to log off on this webinar and you don't get your question answered, feel free to email us. Our contact information is right there. So Corey, I don't know if you want to kick off.
Thanks, Mike. Yeah, there was a question. I actually think I saw it in chat, not in the question thing, and I wrote it down actually on a piece of paper when we started this thing, and I haven't seen anything definitive out there. Have they said anything about accrual versus cash in terms of gross receipts?
Yes.
So,
I'm sorry, Matt, go ahead.
No, go Matt, it's okay.
So it's going to be whatever you use on your tax return. So if you file on an accrual basis, that's what you use. If you file on a cash basis, that's what you're going to use.
Thank you, Matt. Sounds logical. That was my guess before I knew what the answer was, but I did see somebody ask that question. So Jack, you're welcome. Shout out. How's it going? Next question. Are health insurance premiums required to be included in the qualified wage calculation? Question. If
So
not,
you don't have to include health insurance. It's just if you wanted to, you could include it for any like employer contribution. So where we're seeing this maybe is if you furloughed somebody, but you still decided to pay their health insurance as kind of a credit to kind of keep them in good faith and not completely put them in a bad situation. That is kind of where you could pull in those health plan expenses. So you don't need to. If you got more than enough wages and you're not worried about it, or not worried about R&D, go ahead and just take the gross wages. That's fine.
thank you, Meg. Are you allowed to include all ERC for 2020 on the fourth quarter 941, or are you required to open all quarters and refile all 941s with each quarter's ERC claimed?
So this depends, and it also depends on kind of the status of your PPP forgiveness application as well. So unfortunately, if you kind of had PPP and you look like you already applied for forgiveness, they're making you go back and do each quarter, unfortunately, and reopen all those quarters.
You mentioned self-employed individuals do not qualify for ERC. What about owners of a business who are also on the payroll, such as S Corp shareholders?
Yeah, so right now we're including those wages. This is a very gray area. You'll likely read conflicting news articles about it. We've gotten the guidance from BDO, which is our partner. They're the 5th largest CPA firm in the country, and they're taking those wages right now. So we are as well. Obviously, this is subject to change based on guidance.
And kind of to piggyback off that with PPP, the way things worked was you could operate under a set of rules, and then if guidance came out later on to say that that wasn't the case, then you stop doing that and continue on with the new guidance. So yeah, I think there's precedent out there to take a position, like Meg said, make sure you document the file and specifically document when you took this position and made and filed the actual claim for this stuff. Because if you can show that that was before or after guidance, that's going to be a good fact for you. Can you submit a revised 941 when you have the financials done? So yeah, you got 3 years to submit a amended 941 to claim this tax credit if you've already filed one, like Meg talked about earlier. Are S Corp owner wages eligible for the credit? We just did that one. So here's another one. My business, it's a medical office, was considered essential, but still needed to partially shut down because of the impact of COVID in the community and patients staying away voluntarily or told by us to stay away for the time being. Our offices have since reopened, but our services are significantly scaled back because of COVID remains relevant in reducing patient activity. Is that significant enough to qualify?
So this
I
is
think you
likely
got.
going to be like too complicated to answer over the call, because it can kind of be a gray area if you're voluntarily shutting stuff down and your customers just aren't coming. There's not really examples that heavily support that, but looking at like what rules you were under and what percentage revenue that was of your business. So maybe just contact us offline and we'd be happy to help you.
Thank you, Meg. Just to clarify, this 50%, 80% test is based on revenue or cash receipts. Depends on what box is checked on your tax return. So look at your 1120, your 1120S, or your 1065 and see whether cash or accrual is checked on that tax return. Or for those sole proprietors or single member LLCs, check your Schedule C, what box is checked there. Would identifying specific employees for PPP versus ERC be a clean, straightforward way to keep PPP and ERC wages separate if the 24 weeks of PPP overlap the 2 quarters of ERC eligibility?
Yes. Just make
Sounds logical to me.
still look at them for like FTEs from your PPP perspective. But I guess one thing I would caution doing that is the ERC is subject to a smaller limit per employee per employee. So it's not like you could say, oh, you know, I'm going to claim $20,000 of ERC. No, that's capped at 10,000. So that's where it might not work super well, but just as long as you have a spreadsheet that's showing that. So kind of what we're doing is we'll look at our PPP covered period, and then we kind of take out any ERC that we have to allocate to that or that we already used, and kind of subtracting that out. So it could possibly be a method, but I don't think you're going to get the best result that way.
Agreed. Are unrecognized gains on investments considered parts of gross receipts or not because it is an actual cash receipt? It is not an actual cash receipt.
Yeah, correct. You would just use
I think that has to do with the. We are a nonprofit organization with 2 employees. We receive PPP 1 and 2. We are, would you be able to guide us if we qualify or not? We can provide, yeah, feel free to contact us. We can help you out. I work for the SUNY Fredonia FSA, the Auxiliary Service Corporation. Students were sent home statewide in March of 20. Seems that would be a government order from mid-March to August when students could return. Would like to learn what you know about that. Would also like to learn about the aggregation rules pertain. We are 5. Yep. So contact us offline. We'll answer your questions. There were various configurations to ask for forgiveness on PPP loan. Do we have to exclude the wages for calculation on ERC as we are asked for forgiveness, or can we allocate those wages differently after the fact to take full benefit of both? Example, other expenses were eligible for PPP loan forgiveness, but it was easier to just use wages. Meg, I think you answered that question.
Yeah, unfortunately, the IRS guidance was not favorable regarding this. So stay tuned in case anything on that changes. But as of right now, no. And I don't think that, I think if you tried to do that, the IRS is just going to walk in and deny it right away if they were to ever audit it.
Cross your fingers. I have to leave the meeting to get my COVID shot. We can communicate offline. Okay. Yeah. Yes, reach out to us. If one has less than 50 employees and were never shut down by government orders, can one still qualify? Yes, if you hit the gross receipts test, right?
Mm-hmm.
What is excluded in gross receipts for the ERC? Anything?
So yeah, gross
Right?
is most things except for like sales tax and things like that. If you want the specific definition, just email me and I can send it to you. But basically, kind of just think when in doubt, it's probably included.
I assume that the decline in gross receipts test for not-for-profits will include HERF grants as part of the gross receipts. HEERF sounds like an acronym.
Yeah. So basically, for our nonprofits out there, any grants you're getting, and even if you have to use those grants for wages, like if you're paying for wages with grant funding, you're going to have to reduce your ERC by the amount of grant funding that you received. So it's kind of, you can't double dip external funding, and you have to include that additional funding in your gross receipts.
Thank you, Meg. This is a good question. What if you own your business through an LLC and the brother-in-law works but is not an owner? I think you look through all that stuff, and if you're 50%, you can't claim your brother-in-law. But panel, what do you think?
I would agree.
Yeah, I would agree as well.
So related to the owner. Okay, that's just but not related to another employee. Got that. Are S Corp owners' wages excluded, or only the owner's relatives? I think we need guidance on that, right, Meg?
Yeah, so right now we're S Corp owners are okay. Their relatives are not okay, but their spouse is weirdly okay. So we're kind of hoping that the IRS clarifies that a bit more. There is a lot of confusion in the accounting world about that.
And brothers and sisters not related to the owner can count. Is the ERC the only way to get reimbursement for wages paid under FFCRA?
Oh, no, so FFCRA is a different program from ERC. So FFCRA is for if you have, people that had to take care of somebody with COVID or quarantine due to COVID. There's a whole set of qualifications for it, but that's different from ERC. So that's up to like a 2-week benefit, and that's also claimed on your 941, but then ERC is a different program.
Thanks. And somebody asked to go over the interplay between PPP and ERC again. I think we went over that a few times. If you still have questions, please reach out to one of the panelists and we'll help you out. If a cash basis taxpayer wants to use accrual basis gross receipts, you can't do that. You got to use whatever's on your tax return, and that whatever box is checked. Are 50% S Corp owners' spouses wages ineligible? They are ineligible currently, like Meg just said. Hypothetical, if we have at least a 20% drop in gross receipts for the last quarter of 2021 and received a PPP loan at the beginning of 2021, should I be looking only at the wages paid in the last quarter for ERC?
So
I believe that is
only take it in the quarter that you qualify for. So if you qualify in the fourth quarter, you would just be looking at fourth quarter wages. It's just when you have PPP and ERC, you can't double dip any wages.
20% decline test, either prior year or prior quarter. Can you use different measurement period for each quarter?
No, so they would just be your calendar quarter, and it would relate to that same calendar quarter in 2019.
Any tips or tricks on how to reconcile filling out, I need to learn how to read the new 941 X when you use the old 941 for the 2020. The instructions and lines do not match up with the old form. The IRS has issued guidance on this. You can call my wife. She actually filled it out for one of the companies that she helps out with. It was a real pain. I had to help her. I think it took us about 2 hours. Now I'm joking. Probably about 45 minutes to an hour. It's actually really annoying. I'd make any suggestions.
Yeah, just
reach out to us. We'll try and help.
Yeah, we'll definitely try to help you with it.
It is, I agree, it is horribly confusing and just terrible. I didn't like it. For the first quarter of 2021, can you compare to the first quarter of 2020?
Not that I've seen kind of in the guidance. We haven't really gotten full guidance yet on 2021, but I don't know.
Oh, you got to go to 2019. Yep. Sorry. Should I exclude investment income from my gross receipts test?
Nope, you would include it.
No. I think we're done.
All right. Well, thanks for.
And we still
go outside and take a nice walk when it's really on this beautiful day. But if you have any questions, feel free to reach out to us. And thanks for hanging in there. We apologize for going over with our questions, but we want to help you. So definitely reach out if you have anything else that comes up.
Thanks, everyone.
Thanks, everyone.
everyone.
Take care. Thanks, Matt. Megan, Corey.
Sayonara.